Welcome, everyone. We're pleased that you have joined us for today's webinar, Managing Capital Gains Taxes. The webinar will last approximately 15 minutes, and at the end, you'll be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limeberg, and he regularly speaks at industry events. His latest book, Sell Out: The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available on Amazon. And here he is.
Thank you, Amber, and welcome to today's webinar titled Managing Capital Gains Taxes. Appreciate all of you attending. This is one of our free monthly webinars that are open to all financial and insurance professionals. And so if you're an attendee today and you know someone else who might benefit from the kind of topics that we cover during these webinars, um, please let them know. We'll be glad to welcome them into our community of webinar listeners. Uh, as a reminder, we do put on these webinars every month. January's topic is going to be the 2024 numbers topic. We'll go over the 2024 changes to pension, gift taxes, and other relevant numbers during that webinar. So feel welcome to join us on Wednesday, January 3rd at 11 o'clock Central, our usual time. And if for whatever reason you can't make the webinar, a recording of that will be posted to our YouTube channel, as will a recording of today's session. Before we get into the meat of today's session, let's go ahead and vote for February's topic. The three choices for February are: first, the Aretha Franklin estate update. The second choice is buy-sell mistakes create estate tax problems. And the third choice is fighting with the IRS. We'll go ahead and open the poll and ask you to cast your vote for February's topic. Please cast your vote. If you haven't yet cast your vote, please do so. We'll close the poll in just a second. All right, let's go ahead and close the poll. I'd like to thank you for voting, and Amber will announce February's webinar selection at the end of today's session. So let's get into the meat of managing capital gains taxes. We're going to talk briefly about four things. And I say briefly because it's impossible to do a comprehensive coverage of capital gains taxes in the short time that we have available to us. But we'll at least touch briefly on some of the key concepts. We'll first of all talk about what capital assets are. We'll talk about basis, and we'll talk about how the capital gains taxes actually work. And then we'll briefly describe some of the management strategies that we at Advanced Underwriting Consultants get asked about over and over again. Strategies to manage capital gains taxes either now or in the future. So let's start with capital assets and talk about what they are. In general, all assets are capital assets. It's easier for the IRS to carve out exceptions, things that are not capital assets, rather than to go into a list of what all capital assets are. And you can read about this at the web link that's provided on this slide. But in brief, business inventory, accounts or notes receivable, most kinds of intellectual property, such as patents or copyrights or supplies that are consumed in business, are not capital assets. Um, in addition to that, those of us in the insurance world or the financial professional world understand that qualified plans or non-qualified annuities are not capital assets. Rather, they are income assets. And so they don't get capital gains treatment, the kind of capital gains treatment that we'll talk about in today's slide. But most assets are capital assets. So let's talk briefly about what is basis. Basis is the starting point for understanding what basis is the purchase price of a particular asset. If we've got a taxpayer that we're working with, the original basis is what they paid for, the net of what they've paid for that particular asset. Why is basis important? Well, when an asset is disposed of, generally by selling the asset, basis is recovered tax-free, and it's only the gain that we're worried about taxing, or the loss that we're concerned with from a capital gains perspective. Basis can be adjusted up or down during a taxpayer's ownership. Basis can be adjusted up when value is added to the capital asset. Some examples here are adding a room to a rental home. If we've got a client that owns a pass-through business, income from that pass-through business that is not distributed to the owner will generally increase the owner's basis in the business. And so if the owner has undistributed business profit and subsequently sells the business, that undistributed profit will have increased the owner's basis and will result in a lower capital gains result for somebody who sells a business. Depreciation, tax claimed depreciation, is one way that basis can be reduced. For example, if you own commercial real estate and you take depreciation on that real estate to help shelter some of the income associated with rents from that real estate, well, that depreciation can reduce basis. Also, if you partially sell an asset, that can also reduce the basis that a taxpayer might have in it. Keeping track of basis is important because it dictates the final tax result on the sale of the underlying asset. The gift of an asset generally involves carryover basis. That is, that the new owner has the same basis in the asset that the old owner had prior to the gift. There are some exceptions to that, but that's the general rule. And transfers of capital assets at death generally receive an adjustment to basis to fair market value as of the date of death. We talked last month about grantor trusts and how when an asset, a capital asset, is not included in the taxable estate of a decedent, there is no adjustment to basis. But most capital assets are included in the estate of the owner, and therefore they get an adjustment of basis either up or down depending on the fair market value as of the date of death. So let's talk about the imposition of taxes briefly. These are the long-term capital gains rates for 2023. We've got a 0% bracket, a 15% bracket, and a 20% bracket. And so because these brackets are generally lower than the normal income tax brackets, they are relatively favorable federal tax rates. These are the rates for long-term capital gains. Short-term capital gains, net short-term capital gains, are taxed at ordinary income rates. So whatever the taxpayer's regular federal income tax rate is, short-term capital gains are taxed at those rates. Generally, all capital gains and losses recognized in a particular year are aggregated to determine whether the client has net gains or net losses. This concept is important when we end up talking about management techniques in a little bit. One of the things that everyone should be aware of is, particularly for those who are in a potential 20% long-term capital gains bracket, net capital gains are also potentially subject to the 3.8% Medicare surtax for high-income taxpayers. So the actual highest capital gains rate can be an effective rate of 23.8% federal. That needs to be kept in mind as we worry about the taxpayer's potential tax liability for disposing of a capital asset. We often get asked about this at Advanced Underwriting Consultants. Capital gains are stacked on top of other taxable income to determine which bracket might apply to a particular taxpayer. So, for example, if we've got a joint filer with $80,000 of taxable income before we worry about a capital gains transaction, if, say, they've got a $50,000 capital gains on top of their $80,000 of other income, the first $9,250 of gain will be taxed at the 0% bracket, meaning that $9,250 will not be taxed, but the balance of just over $40,000 will be taxed at the 15% bracket. And so when you've got somebody just below the capital gains threshold for a 0% bracket, it doesn't mean that they can sell an unlimited amount and still get the benefit of the 0% bracket. They will straddle that and be taxed at the higher bracket or brackets depending on the size of the transaction for their capital gains. And also, when we're worried about capital gains management, we should also be concerned about state income tax implications. Some states have no state income tax. Other states have separate capital gains taxes from normal state income tax, and other states treat capital gains as ordinary income for state income tax purposes. It's important for you to be familiar with how those rules might affect your clients in the particular state where you're working with them. So let's go on to at least a bit of a survey or a synopsis of some of the management strategies. Dying at the right time is one strategy for sure. It's not a popular strategy if we suggest to our clients that they die owning appreciated capital assets so that their heirs can get an increase in basis, but it is a fact. It is something that people can certainly think about. Hanging on to a capital property, particularly an appreciated capital property until death, is an effective way for basis to be properly adjusted at death. One strategy that makes the rounds, particularly at this time of year, is the idea of bracket filling. If we've got somebody who is in a 0% federal income tax bracket, and they've got some room in the 0% capital gains bracket to cover capital gains, they should consider selling appreciated assets so they can take advantage of the 0% rate and not have to pay capital gains on the sale of those assets. In the example I gave earlier, if we've got a joint filers that have taxable income of 80 grand, they should consider recognizing $9,250 of capital gains in 2023 because they won't be taxed on those gains. They'll be in the 0% bracket, and that would be the way that they would fill out that particular bracket. It's an example of the bracket filling strategy. So another idea for managing capital gains is capital loss harvesting. If we've got somebody with a large capital gain that they've recognized during the course of the year, and if they've got other positions that are in loss positions, they might consider selling those loss positions so that they can balance out the capital gains they've recognized earlier, Remember, I said at the beginning that capital gains and capital losses are balanced against each other for the purpose of figuring out your net capital gains for a particular year. And so loss harvesting is a strategy that certainly ought to be considered here at year end for our clients who might have significant capital gains that they've recognized during the course of the year. An idea for somebody who has highly appreciated capital asset to implement is charitable giving. If someone makes a direct gift of an appreciated asset to charity, their potential itemized charitable income tax deduction is based on the fair market value of the capital asset when the gift is made rather than their basis in the asset. And so that is relatively attractive for somebody who has charitable intent. Likewise, it makes sense for somebody who has a substantial charitable or a substantial capital asset with substantial gains inherent in it to consider a sophisticated charitable giving technique like using a charitable remainder trust to give away that asset. Again, the value of the tax deduction will be based on the full fair market value of the asset rather than the taxpayer's basis in the asset. Charitable gift, if done properly, will avoid having the client recognize capital gains when the gift is made. However, charitable giving involves a fair amount of legwork, a fair amount of administrative cost to implement, and so it's not for everyone. It's really only for the right fit. We end up talking about, in our experience, sophisticated charitable giving, such as charitable remainder trusts, a lot more than we actually implemented. But for the right situation, it is an idea that ought to be considered. Another idea to manage the timing of capital gains taxes is to use an installment sale. If, for example, the owner of the property is comfortable with a buyer buying a particular capital asset over time, the capital gains result can be spread out over multiple years, over the duration of the installment sale. And so, again, it's not a fit for every situation, but it is certainly something that can be thought about where a client is trying to manage capital gain taxes and perhaps spread out the income tax result, the capital gains exposure result associated with the sale of a substantial capital asset. One idea that had been making the rounds for a long time is the idea of using a deferred sales trust to kind of force fit installment sale treatment into a transaction that would normally not be the right fit for installment sale. A deferred sales trust is kind of an artificial construct where the seller of a particular asset would set up a trust to help facilitate installment sale treatment for the sale of a particular asset. This is an idea that had been making the rounds for a long time. However, the idea has gotten on the IRS's radar, and most such implementations, most might be an overstatement, many such implementations would now potentially be listed transactions from the IRS's point of view. And that's why, from our perspective, if we've ever recommended them in situations before, we really don't recommend them anymore because we don't want our clients to become famous. And then another idea for managing capital gains taxes is a 1031 exchange. This is often used in conjunction with commercial properties where we've got somebody interested in selling a particular commercial property, but is not necessarily interested in getting out of the commercial property business. They trade one commercial property for another using a very specific set of administrative procedures to pull off the exchange. And if they do it properly, they defer the gain on the sale of the existing property, essentially by replacing it with a new commercial property. That is certainly something that is available to some clients in the right circumstances. So that's a quick survey of ideas that agents should at least be a little bit familiar with in their helping their clients to manage capital gains taxes. So what are the lessons that we ought to take away from today's session? First of all, um, thinking about capital gains, that's got to be part of what we're prepared to talk about with our clients. And for a lot of our clients, simple ideas such as bracket filling or loss harvesting are going to be relevant. And those are things that we should discuss with just about anyone who's who has capital assets and is worried about the future or present liability for capital gains taxes. There are tax risky strategies. Charitable giving is a sophisticated strategy. Deferred sales trust is a tax risky strategy. Those discussion of those things should be saved for unique situations, but we definitely need to be prepared to talk about those things where the time is relevant. And that is it. And I would like to thank you again for attending today's webinar.